Hi, this is Mohan Kumar from Brainy Bulls, and I welcome you to another episode of Nifty chart analysis using Triple Threat Intraday Strategy. So, in this video, we're going to look at the Nifty chart for April 13th and see what kind of trades the strategy has indicated. Come on, let's quickly get into the charts. All right, so this is the trading view charts. It's a two chart view. But we have the Nifty spot on the left and the Nifty futures chart on the right. Okay, so this was the price action for 13th. It's a quite an interesting move, isn't it? But how do we know, where to take our entries and where to exit, right? How do we know? How do we, gauge the market moves? So let me bring on the triple threat, those three indicators based on which, I execute trades, right? So it's a 3 minute time frame charts, and I have three indicators. Most of the elements that I use are in forms of three, okay? And I've been discussing about this power of three in bits and pieces in the videos that I've uploaded so far. So you will get to hear a lot about the power of three in my upcoming videos as well. So let me quickly bring on the indicators. The first indicator is the price levels, which are nothing but the locations which I talk about. The first entry condition for me to actually look for getting into trades is the location of the price. So I have three kinds of locations, right? The daily pivot levels, okay, which includes the central pivot, right? And I have the previous day range, a high low, and the previous day close. That's the second set of location, and the third is the major turning points from the past, right? So these three, again, I have three moving averages. The that's again, it's a moving average band, right? And I also have the volume candle. So these three elements forms the price levels indicator, right? And let me bring on the second indicator, which is the market participation. So again, I have three colors. I have the black or the purple, right? They indicate one type of participant. Then I have the blue and I have the green. So again, three different kinds of participation, which again indicates the momentum, and momentum is the key to trade in Nifty options. And the third indicator is the trend meter. The trend meter indicates as to whether the trend is weak, the trend is strong, the trend is bottomed out and it's going to reverse, or the trend is peaked out and again it's going to reverse from the top, or is the trend going to continue, right? So what's the kind of trend that currently the market is making, right? So that's about the indicators. And along with the indicators, I look at the price action patterns, I look at the candlestick patterns, right? I look at the opening levels. I'll take into account the previous days, major turning points. So all this will put together into the mix, right? Will give the signals as to where to enter and where to take profits. Okay, so for the first 30 to 45 minutes, 9:15 to 9:45 to 10 o'clock, right? So we observe the market, where the price is, what's the location, and what about the EMAs, whether they are sloping, raising or falling, right? And we look at the trend meter, and we look at the kind of participation that has come into the market in the first 30 to 45 minutes, right? So on 13th, the price opened between, right, the yesterday's range, as you could see, and the price is right between two levels, which is the central pivot and the previous day high. Okay, and you could see the price is also kind of like between the moving average band, and the trend meter, as it indicated, it's not peaked out, but again, the price action with the EMAs are all mixed up, and two major locations being close to one another, right? So it's not a very clear move as to which side the market is headed towards. But as the time progresses, around 10 o'clock, we see that the price is moving firmly to the down, and it's actually getting a strong support at the central pivot on the spot chart. However, on the futures chart, the price has gone way past below all the EMAs, and it's even the candles closed below the daily pivot, and it's taking a support at the day's low, right? So we get to see the trend meter. The trend is kind of like it's falling. It's right in the middle. It's not bottomed out, and we could also see that there is not much of a participation right here in this region, right? But we did have a strong participation at the previous day high, and it looks like the price is mm, the price is weak, and it's actually falling. But we are yet to get some strong signals whether the moving averages and the CPR, the central pivot range, is going to hold the price or not. So as the time progresses, we could see the price retraces back to the moving averages. And at this point in time, we are getting to see a confirmation that the moving averages are kind of like sloping or falling down, and it's very clear, it's evident from here. And once the moving price moves below the moving average, right, from above to the below, and once the price retraces back into the moving average, right, and the moving averages are so close to one another, and look at the price trend, it is also right in the middle. It's almost like falling down. This is the place where you look to buy, and there's not much of a participation from the bottom moving the prices higher. So these participants right at the top are major participants who are now planning to push the price even more lower. And now this is the candle, a strong candle, right, around the EMAs, pinning the EMAs. Now this is the candle which I bet on. The top of the candle is my stop loss, and the close of this candle is my entry. So this is where you take the trade. The first trade is around this level, right? This is the candle, and you trail your stop losses, and you're into the trade as long as the trend meter gets into the green zone. That indicates the bottom. So it's a firm move from the top, almost down, right? And we get to see the price now reaching to the major location, which is the previous day low. Now, and also we get to see participation, which is the black dot. Now, this is the place where we take our profits. The trend meter indicates that it's bottomed out. The price is at a location where it might reverse, and also we got the participation indicator as well. Okay, and we got a good move to the downside. Okay, perfect. So that is how we assess the price action, based on whatever it prints on the chart. So we don't guess, we don't expect, we don't anticipate that the market will move up or down, but rather we see and we act, right? That's the best thing about this triple threat. It is not just based on one signal or just one concept. It's a mix of everything, right? It's a mix of price action pattern with the indicators, and with the trend and everything. And that's the strength of this triple threat. Okay, we have three indicators, we have the price action patterns, we have the candlestick patterns into play, and we see the first 30 to 45 minutes as to what the market does, and then we take a calculated and informed decision about which trade, which side to stick to, long or short. And this was a very good opportunity. So we would have taken short position, bought puts, at the money puts, and we would have easily made some good profits. It's like 17,845 on the futures short to 17,782, about 50 to 60 points on the futures short. That corresponds to 30 points on the options at the money strike price chart. So it's a great first trade. Now let's look at what are the opportunities that the indicators have signaled. Okay. Let me quickly clear the drawings. All right, just give me a quick second. All right, great. So, so the price is at a major location. In this case, the previous day high. Usually we need to be very watchful. That's why it's called a major location, because it's a make or break level. So in this case, it did not go past, and it took strong resistance, and it tend to move further down. But no, we don't take trades right here, because no, there is no guarantee that there is no hard and fast rule that every time the price is at a previous day high or a previous day's low, it will reverse, right? So we always take some, we'll be very cautious about, because it's kind of it's our money, and we need to be actually be very very cautious when we get into trades, because hitting stop loss is one. Of course we're going to risk only one candle, but still, we need to be very sure about what we are doing. Hence, in the first 30 to 45 minutes, it'll be it'll be very volatile. Okay, the prices will fluctuate, and it'll not give us a clear indication. So even with a pin, with the inverted hammer, with a lot of participation, we still do not jump into trade right here. We want to see the price is moving way past below the EMAs, and then when the price retraced back, in this case the price was like moving within the band, and then there's a slight retracement, and then we made a decision to go down, looking at the price action of the last 1 hour, right? So that's how we take trades. And but also, why do we use two charts? It's a very good example. On the Nifty futures chart, the price has come close to the previous day's low, which is a major location. But look at the spot chart, the price is little far away from the previous day's low. And if we would have only had the Nifty chart, we would assume that okay, the price is still far away from the previous day's low. Let's hold on to it. And also look at the participation. There was not much of a participation on the spot chart, right? On the spot chart. But look at the futures chart. The price is almost close to the previous day's low, and also there was a participation that came in. So we know, if either of the chart gives us indications of bottoming out. And look at the trend meter. A trend meter in both cases has given us clear signals of the price bottoming out. But on the futures chart is where we know that it's at a major location and the participation has come in, so we need to exit. So that's why we use two charts side by side, and we take informed decisions about when to enter and when to exit. Okay, so it's like when you want to buy something, right? You always get a second quote from a different business or a firm or a company, right? Just to ensure that whatever price offer or quote you have is the best. So on similar lines, you have these two charts, of the same kind, but their price action slightly differs, right? Spot and futures, their locations will be slightly different, differently positioned. So we take into account both, and putting both of those into perspective is what we use as signals to trade. So moving on, the first trade was a very good trade, and again, so the price is at a location, it's at a daily support. Here it's at the previous day's low. There was some participation here, so we don't jump into the trade right away, right? Like I always talk about it. So we always give some time, some cushion for the price to actually go, have some impact with the EMAs. Okay, if the prices are way below the EMAs, the price will have to retrace back to the EMAs. And and the price will now either sometimes the price will move far away. It'll make a parabolic move. There is no guarantee as to whether the price will retrace back. Sometimes it moves, sometimes it goes, and it even breaks the previous day's low. So it's brutal, right? But again, so that's why we have a lot of signals in play, which gives us some indications as to what the price action is bound to do. So in this case, the price retraced back to the EMAs, right? And then look at the indicator, right? So this the trend meter on the spot chart barely moved to the midway, but on the futures chart, right, the trend meter again, it takes into different parameters, and then it actually prints the trend for us. And the trend is almost at the red zone, right? And but this is not. And look what happened right after that. The price fell down aggressively, and it actually came as low as to the previous low point, and it even touch touch the previous day's low. Okay, so here as well, the price tend to move as close as to the low that was printed earlier, right, in the spot chart. And this is where you see a lot of participation, right? You do not see this much of participation anywhere since morning, right, on the spot chart. And at least on the futures chart you had some participation, here and here. And but collectively, when you look at both the charts, the participation here at this zone, right at the bottom, right, close to the previous day's low, is really huge. And look at the trend meter. Again, it has actually come back all the way, from the top to the bottom. And this anyway was at the midway point, and it actually, uh, came back to the green zone. Now, the important thing that you have to notice is the price made a lower low, kind of a lower low, right, as you could see here. But the trend actually, it printed a higher low, okay, on both of these charts. Look at it. Even though it is a very small difference, right, but still it's a lower low. But look at the trend meter, it made a higher low. So this indicates that the trend on the downside is kind of weakening, and now it's time for the price to reverse. Look at the candle pattern. You have some candle volume, and then you have a big candle that takes out this right from the previous day's low on the futures chart. And similarly, there is some participation on this candle, okay, and this candle has taken out. Now this is an indication that aggressive buyers have entered the market. So you take the trade right here, okay, your stop loss is here, and you write this until, as long as the trend meter is into the moves into the red zone. So regardless of which moves first, you take your profits, because options, the premium moves quickly. You cannot wait, for the price to actually, swing and then again catching up. You will have to take quick profits. So in this case, as soon as the indicator, the trend meter, gets into the red zone, and look at the price action, it is close to the topmost moving average. It is close to the previous high point, and there are participants who are entering into the market, which means participants, when the meter is at the top, the trend meter is at the top, is moving the prices further down, is evident, like it's obvious. So you take your profits right here. So it's a very good move, it's a quick move. You would have definitely made some good profits here as well. Having said that, the price has taken a good support from a key location, and the price has moved past the moving averages, right? The moving averages have flattened out, but still it has closed firmly above the moving averages, right? And now there will be a retracement. So we don't want to wait. We don't want to be into a trade when the retracement happens, because the retracement is not guaranteed. The retracement may actually fail. It'll go all the way back to the previous day's low, and it may even breach, right? So we don't want to take any chances. So we exit the trade, and we look for further signals whether to re-enter the trade at some good point. So as you could see, this chart did not have the trend meter, moving into the red zone. So we do still have some kind of, um, strength in the buy in the up move. So we look for some good retracement point, and then we take up a follow-up trade. So the price moved firmly below the EMAs. So again, we do not know what's going to happen, but it took support at the daily, support, the green line, and it's moving back above, right? And it has gone to the top point where it took the resistance, and it's again actually, taking the support at this EMA. As you can see, the moment it goes above the EMAs, right? And if it retraces back, just the opposite of what happened in the morning hour, right? It went below, retraced back, but in this case, it went from below to, no, breaking the averages to above, and then it retraces. There is a pull back down to the EMAs. Now, this is the zone we take the trade. And look at the participation. Look at the green candle on the spot chart with participation. Now, this gives a clear indication that the price is bound to move higher. We know there is a strong resistance. Let's see how the trade works out, and find out now the kind of profits that we will be able to make in this particular trade. So we get into the trade right at the top. So this candle's low happens to be our stop loss point, and this candle's high is where we enter into the trade. And as the candle moves close to the CPR, a major location, one of two things can happen. It can take a strong resistance, and it can actually, move, all the way, reverse to the bottom. or it may actually break and go past this. So in this case, you could see that the price already took a strong support at the previous day's low, and it has actually shown some momentum. It has broken the EMAs, and from the EMAs it has actually broken past and broken the resistance, this zone where we had some good participation, right? And it has moved past that. So the chances of the price moving even way beyond this point is more, right? And besides, the green EMA is now it's raising all EMAs. The blue and the black, it's still not clear though at this point, but the green is firmly raising on both the charts. So we are going to trail a stop loss as per the green EMA. If the candle closes below the green EMA, that is when we take our we take our profits or book losses. But in this case, even closing below the EMA, we would still not be into a loss. We would be at a break even probably. So we're just going to wait and see what the price action is bound to do. And also the trend meter, it has peaked out here, right? And it has actually it's into the red zone here as well. So our stop loss is going to be below this the big candle that's right here, which is into the between the blue and green. And we're just going to wait and see what the price action does. And since we are sure about this move that started right here at around 12:30, okay, and it's pushing the prices even higher, right? And we are also waiting for the price action to confirm if it's going to move higher, above the central pivot, which happened. So we know for a fact that the price has come back to the point where it reversed in the morning, right? So this is a very strong zone. This is a very strong zone. There could be some aggressive, sellers at this point. So we don't want to take our chances way past this. And there is a participation here as well. And look at this. Look at this. It's in the red zone. It's in the red zone. So we end our trade right here. Remember, it's a follow-up trade. So we actually took this trade, and we made some quick profits. See, on similar lines, you could have actually taken a trade here as well, right? Because this has given us a clear indication, right? See, this is the high point, and this is the next high point. It's kind of like it made a lower high, but look at the stochastics, the trend meter, right? This has made a higher high. So this is the conflict of the price and the trend itself, the trend meter itself. And you could have taken a small trade here, and you could have made some good profits here as well, right? But anyways, there are a lot of follow-up trades that we could take, but I'm only focusing on the actual trades that I take, based on the signals it generates, and the other signals I simply ignore in the interest of time. Okay, so on this particular day we made a very good trade, three trades, right? As you could see, we took three trades, one in the morning. Excuse me, I just keep messing up with the freeform drawing. And okay, so this is one, okay, and based on clear facts. This is another based on clear facts, and this, we know for a fact it's right above the EMAs, and this was another. So three good trades, and we could have still actually taken a good trade right here, but post 2:30, 2:45. This is Thursday expiry day, so we have to be very conservative about the trades that we take, and but still we're not so greedy, so we took three trades, and all three trades ended up in profits. So this is how we actually trade based on facts. We don't gamble, because that's one of the reasons why people fail. We should trade based on what we see, and what we see should be uh, the set of rules as defined by your strategy, right? So that is the key point. Strategy doesn't talk about just what indicators to use. It talks about your how to manage your trades, how to manage your risk, how to manage your money, right? And it also talks about a bit about you being cool headed when you're in the trade. Okay, because you're now trading based on facts, okay, and not you blindly taking trades, like entering and exiting without any kind of solid reason behind your decisions. So just look at the chart without any of these indicators. You would not know uh, at what point you should be able to take your trades, right? It does not give. So for what we see, the price is moving, and we would have only gauged that the price is going to move further down, right? Looking at the price action, lower lows, right? Printing lower lows, right? On all these charts, this is the trend, right? And but here we actually entered right here, but on what basis we entered right here? So people draw the trend line, and people, when the price breaks the trend line, they take the trade, or when the price actually retraces back, they take the trade. So there are a lot of strategies out there. So that's one way people do it. Okay, but we have a solid strategy in place. We don't actually draw trend lines. We don't take trades based on trend lines and all, right? So we take trades at the bottom and we exit trades at the top. That kind of precision is what the strategy helps us with, so that we will be able to get into trades early and get out of trades much early, right? So that's the triple threat: the location, the participation, and the trend meter, which is built on top of the stochastics, right? So these three gives us clear facts, clear indication as to what the market is bound to do, and we go along with it. So I hope this helps in understanding the power of putting multiple concepts into the mix and you making trading decisions based on it. And the triple threat strategy is a very unique strategy, and it was not. It is a result of many years of me, working in the market. So I've actually traded in multiple time frames: 1 minute, 2 minutes, 3 minutes, 5 minutes. Right now, I've traded in cash market, like equities, stock futures, index futures. Right. So I've traded in Nifty, Bank Nifty. So taking everything into consideration, right, I finally narrowed down my concepts into three simple rules, and I actually preferred Nifty for many reasons. So these are all the facts that we're going to discuss in the webinar as to why we chose Nifty, why a 3 minute time frame, why these three indicators. There are thousands of strategies out in the market. There are hundreds of indicators, but why did I actually build custom indicators? Why didn't I not? Why I mean use any of the out of the box indicators other than the moving averages, right, and the pivots? So all this will be discussed in depth in the webinar, so you get a solid foundation as to why you're doing this, and and why this is so powerful, right? So if you like this content, please to like this video and subscribe to this channel in order to get timely updates on the videos that I upload. All right. So thanks a lot for your time and patience, and you take care of you and your loved ones. See you again in another episode of Nifty Chart Analysis. Until then, stay safe. Bye. Thank you.